Welcome to Chapter 10, the final chapter of Bus 160. And what a way to finish. You can have the most brilliant business idea, the most compelling business plan, and the most sophisticated marketing strategy in the room. Without capital, none of it moves. Today we answer the question every entrepreneur must eventually confront. How do I finance this? We will cover the three fundamental ways to raise capital: crowdfunding and peer-to-peer lending, the detailed mechanics of debt and equity financing, where to find investors, and how to present your business to maximize your chances of getting funded.
There are three fundamental ways to finance a business when personal savings are insufficient. Gifts and grants, capital you receive without any obligation to repay. Debt, borrowing money with a contractual obligation to repay it with interest over time. And equity, exchanging a percentage of ownership in your company for capital. Your choice among these, or your combination of them, depends on several factors: your personal risk tolerance, your business type and stage, your creditworthiness, and your goals as an entrepreneur. Risk tolerance is the amount of risk or threat of loss that an individual is willing to sustain. An entrepreneur with low risk tolerance might prefer debt, predictable payments, no ownership dilution, but real personal financial exposure if the business fails. An entrepreneur with high risk tolerance might prefer equity, no required repayments, but the permanent cost of shared ownership and shared profits. There is no universally correct answer. The right financing mix is the one that aligns with your risk profile, your business model, and your long-term objectives. Gifts and grants represent capital that you do not have to repay. Sources include government programs, often in the form of tax abatements, which are legal reductions in tax obligations, or tax credits, which are direct reductions of taxes owed. Grants may also come from nonprofit organizations, economic development agencies, or private foundations. A particularly exciting and growing form of non-repayable or low-cost funding is crowdfunding. The use of small amounts of capital from a large number of individuals, typically organized through online platforms. Within crowdfunding, peer-to-peer lending matches individual lenders with individual borrowers, creating a distributed lending marketplace. What makes crowdfunding especially valuable for early-stage entrepreneurs is that it accomplishes two goals simultaneously. It raises capital and it validates market demand. If thousands of individuals are willing to contribute money to your product before it even exists, that is extraordinarily powerful market evidence. It is proof of concept funded by the very market you intend to serve. Debt financing means borrowing money with a formal contractual obligation to repay it with interest. That obligation is typically documented in a promissory note, a written promise to repay a specific sum of money on or before a specific date. The principal is the original amount of the loan before interest and fees are added. When a business is financed primarily through debt, it is described as leveraged. The advantages of debt financing are significant. The lender has no say in how you run your business, as long as you make your payments on time and comply with the terms of the loan. Payments are predictable and can be structured to align with your seasonal revenue patterns. And the lender does not share in your profits. The disadvantages are equally real. If you default, fail to meet your repayment obligations, the lender can initiate bankruptcy proceedings. If you provided a personal guarantee, the lender can pursue your personal assets to recover the debt. Debt payments increase your fixed costs, which reduces profitability. And lenders typically require regular financial reporting and strict compliance with loan covenants. When you approach a lender, they will evaluate your creditworthiness across 5 dimensions, the 5 C's of credit: collateral, assets you can pledge as security; character, your personal credit history and reputation; capacity, your ability to generate sufficient cash flow to service the debt; capital, how much of your own money is invested in the business; and conditions, the state of the industry and the broader economic environment at the time of the loan. Understanding and preparing to address all 5 C's dramatically improves your chances of approval. Equity financing means giving up a percentage of ownership in your company in exchange for capital.
An investor who receives 10% equity is entitled to 10% of the business's profits and, more importantly, 10% of its eventual value if it is sold or goes public. The advantages of equity financing include the fact that if the business does not generate a profit, the investor does not get paid. There are no required regular payments that could strain cash flow. The equity investor cannot force you into bankruptcy, and a good equity investor is genuinely motivated to help the business succeed. They may offer valuable strategic advice, introductions, and resources. The disadvantages are also real. By giving up ownership, you risk losing operational control if you give away too much. Investors may become involved in management decisions in ways that feel intrusive. You must share profits indefinitely, and equity financing is inherently riskier for the investor, who will therefore expect a higher return than a lender would. There are two primary equity investor categories relevant to small businesses. Angel investors are wealthy individuals who invest their own personal capital, typically seeking returns of 10 times their investment over 5 years. They tend to prefer manufacturing, technology, and energy businesses. Venture capitalists are professional investment firms that manage large pools of capital on behalf of institutional investors. They typically target high-growth startups with the potential to achieve very large scale and expect returns of 6 to 10 times their investment over 5 years. Both typically exit their investments either through a private sale of their equity stake or through an initial public offering. The most important tool in your financing arsenal is not a pitch deck or a spreadsheet. It is a compelling, realistic, well-researched business plan. Whether you are approaching a bank for a loan, a family member for a gift, a crowdfunding audience, an angel investor, or a venture capitalist, your business plan must convincingly demonstrate that you understand your market, your competition, your cost structure, your revenue potential, and your risks. Lenders look first at cash flow projections. Investors look first at market size and the quality of the management team. Every reader starts with the executive summary. If it does not capture their attention in the first paragraph, the plan is done. Do not overlook vendor financing as a supplementary strategy. By negotiating the best possible payment terms with your suppliers, maximizing the float, which is the time between when a payment is initiated and when it actually leaves your account, you can keep more cash available without borrowing at all. This is working capital management, and it can meaningfully improve your liquidity position without any interest cost. Finally, remember that most successful businesses do not rely on a single source of financing. The most resilient financing strategies are multi-layered, combining personal savings, grants, debt, and equity in proportions that reflect the business's risk profile, stage, and growth trajectory. And with that, you have completed all 6 chapters of BUS 160. In this final chapter, you learned the 3 fundamental ways to finance a business, how crowdfunding and peer-to-peer lending work, the mechanics and trade-offs of debt and equity financing, how lenders evaluate creditworthiness through the 5 C's, who angel investors and venture capitalists are and what they expect, and how to build a multi-layered financing strategy. More importantly, across all 6 chapters, you have built a complete, practical framework for thinking about entrepreneurship. From identifying an opportunity and building a business model, to defining your competitive advantage, researching your market, developing your marketing strategy, and securing the financing to bring it all to life. That is the full arc of entrepreneurship. You now have the language, the tools, and the analytical mindset to engage with it seriously. Complete your Chapter 10 assignment, your final discussion post, and your final exam in Canvas. It has been a genuine pleasure being your guide through this material. Good luck on the exam, and go build something that matters.